Here's a look at the latest events happening in financial planning. Brought to you by JenniferLangFinancialServices.com, where we help American workers and small business owners prepare and protect their retirement portfolios from stock market loss. We specialize in annuities, 401k and IRA rollovers, indexed universal life insurance, and small business owner 401k retirement plans. Please remember to click the like button and subscribe to catch all of our financial news and retirement planning updates. Let's get started. Annuity laddering is a financial strategy of purchasing several annuities of lower value over a period of years. When interest rates are low, laddering can offset the small returns from annuities by allowing the owner to stagger the end dates of the contracts. One of the challenges of purchasing an annuity or investing stocks or real estate is entering the market at the best time to maximize return. A strategy known as laddering, or buying multiple financial products with different maturity dates, is one way to address this challenge. So, what is annuity laddering? Financial laddering is a method of investing in bonds and CD, but it's also a good financial strategy for maximizing the value of annuities. Financial expert and Forbes contributor Matt Carey said in a 2018 Forbes article, laddering spreads out maturities of different fixed income instruments so that you are consistently able to access some funds for liquidity, while simultaneously taking advantage of higher rates on longer-term instruments. It's a strategy meant to increase the chance of earning more money when interest rates swing upward. You might, for example, open a new CD, invest in a different bond, or buy an annuity every year for several years to get the best deal available under the economic conditions of the time period during which you make each transaction. Those conditions include changing interest rates, which the insurance companies determine using factors that include your age and life expectancy. Your age at the time of an annuity purchase, and more importantly, your age when payouts begin, will affect the offer you get for an annuity. Why investors ladder annuities? Laddering annuities is meant to offset sluggish returns. There is a significant opportunity cost to investing in a long-term product when the market is performing poorly. This strategy serves to mitigate this loss. Laddering is attractive to investors for other reasons too. The main benefits of laddering are spreading interest rate and reinvestment risk over time and getting short-term liquidity while taking advantage of longer-term rates, Carey told Forbes. This can be especially consequential when you're talking about setting up your retirement funds, which should not be so rigid that your income can't keep up with the increases in your cost of living. In other words, you don't want to tie up all your money in low-rate vehicles and forego the opportunity to move it into investments that would perform better. At the same time, you don't want to invest in hopes interest rates will go up only to see the rates sink even lower. There are different ways to ladder. A licensed financial professional can help you determine the best laddering strategy for your situation. Your advisor may suggest one of the following tactics. Spreading out your principal. Maybe you have a total of $400,000 to invest in annuities. You can use $100,000 each year toward an annuity purchase. This also allows you to invest part of your retirement savings to see if you're comfortable with annuities before tying up a large percentage of your savings. Another way to ladder annuities is to buy several fixed-rate annuities with different surrender periods. The surrender period is the amount of time you must wait to withdraw funds from your annuity without facing a penalty. If you do need to withdraw more than what is allowed in the contract, you will have to pay a surrender charge. At the end of the surrender periods, you can withdraw your money without penalty as long as you're at least 59 and a half years old. Alternatively, you can move the funds to an annuity with better terms through a 1035 exchange. These exchanges are a way to trade in one annuity for another without tax consequences. The 1035 refers to the provision in the tax code that covers them. If the annuity contract is as good as the offerings at the end of the surrender period, you can keep the annuity contract as is. Having several annuities with different surrender periods allows you to review the terms of each contract at the end of its surrender period and decide whether you could get better returns in another annuity. You can also ladder various types of annuities. For example, you can invest some of your money into the purchase of fixed annuities while investing other funds into fixed indexed annuities or multi-guaranteed annuities. This allows you to have a balance of the advantages and disadvantages of each type. Because each type of annuity has unique benefits and drawbacks, such as the reliability of predetermined interest rates on fixed annuities versus the less stable rates of variable annuities, which are tied to the performance of their subaccounts and may ultimately provide higher returns. If you ladder different types of annuities, you create more opportunity to benefit from or protect your money from market volatility. Finally, in addition to laddering the actual purchase of annuities, you can ladder when they will start paying you income, beginning at the age of 59 and a half. The older you are when you start receiving the payments, the higher the payments will be. This is because life expectancy is one of the factors that determine annuity payout amounts. The longer your life expectancy, the lower your payments will be. Hence, you'll receive larger payments from a deferred annuity that doesn't start paying out until you turn 75 years old than you would from an immediate annuity that starts paying you at age 60. In addition to allowing you to take advantage of different market conditions, diversifying annuities from different companies gives you a layer of protection against the unlikely chance that one of the insurance companies goes bankrupt or runs into financial problems. Let's review with the following video.
When we are ready to retire, we must convert the growth of our savings and investments into a source of regular and reliable income, an income that will last for 20 or 30 years of retirement. Of course, most financial advisors will advise us to withdraw only the interest, dividends, or profit on our investments so that we can never run out of money. But we know that interest rates, stock dividends, and market valuations will vary considerably from year to year, especially over 20 or 30 years of retirement. And if our investment earnings cannot provide us with enough income, we will need to take withdrawals of both earnings and principal, and manage those withdrawals very carefully as we spend down our savings over 20 or 30 years. But if we make any miscalculations, or if our investments do not perform as well as we expect them to, or if we should live longer than 20 or 30 years, we could very easily run out of money. So what's the alternative? Well, we can convert our retirement savings into 3 separate 10-year payout periods, each one with a certain guaranteed income, and the third one with a guarantee to continue the payout for as long as we live, even if we live into our hundreds. These payout periods are referred to as income buckets, and they can replace the uncertainty of interest rates, stock dividends, bond yields, and market valuations with the certainty of a regular and reliable guaranteed monthly income. It's like having our own personal pension plan. What's more, income buckets enable us to safely and confidently take as much as 30% more income during the first 20 years of our retirement, because we know with certainty and assurance that we will have sufficient income guaranteed during the second 20 years of our retirement, or for as long as we live. What's more, we can do it all without any risk of taking out too much or too little, and without any dependence on interest rates, bond yields, stock dividends, or market valuations. So we never need to worry about the safety of our money, or the need to carefully manage our investments. Here's an example of how it works. The first income bucket might begin at age 60 or 65 and pay out all of that money over the first 10 years of our retirement before it would be replaced by the second income bucket. So the second income bucket would begin at age 70 or 75 and pay out a new monthly income, guaranteed for another 10 years to age 80 or 85. And this second 10-year payout can be higher than the first 10-year payout in order to offset the rate of inflation. Now, the third income bucket would only begin the payout if we make it to age 80 or 85. And this third bucket would be guaranteed not just for another 10 years, but for as long as we live, even if we live to be 120. And if we don't make it to age 80 or 85, our heirs will receive annual installments until all the money we put into that bucket is paid back out. Would you like to know how much more money you can get with an income bucket plan? Talk with the financial security professional or the retirement planning specialist who asked you to watch this video.
If your benefits aren't enough to pay for your expenses each month during retirement, Then consider other sources of guaranteed income to cover the gap. Annuities might be an option to look at. After all, they are the only thing besides Social Security that can pay you a guaranteed income for life. Contact us today for more information on Social Security claiming strategies, as well as annuities and how they can benefit you. Together with our help, you can increase your Social Security benefits, maximize your retirement income, and enjoy a comfortable lifestyle with more financial confidence. You can request an initial appointment or quick call to discuss your goals, situation, and explore a working relationship. Also, if you are concerned about rising taxes and inflation, if you are in the red zone and you are 5 to 10 years away from retirement, if you are concerned about stock market downturns, and if you are concerned about rising healthcare costs in retirement, then an annuity may be the key to a secure and comfortable retirement. It helps to have a plan to achieve a more secure future. Get your free annuity quote today. Tax-deferred solutions such as fixed index annuities are safe from stock market loss and provide you with protected growth, lifetime income, a death benefit for your family, and liquidity. At JenniferLangFinancialServices.com, we work with over 25 of the top life insurance carriers to find you the best rate. Let us put our expertise to work and find you the best annuity for your age, time horizon, and goals. Get started today. Please remember to hit the like, subscribe, and share buttons to stay up to date on the latest retirement and financial planning news.